Okay, let's dive in. Welcome to the Deep Dive. This is where we take the material you've shared with us and really try to get to the heart of it. What's key, what's maybe surprising, what you really need to grasp.
Yeah.
And today we're tackling a particular challenge that one source sees for credit unions. And it's not the usual story, is it? Not the big banks this time.
No, this comes from the fintech world. Digital assets. We're looking at an article, The Silent Drain, Why Credit Unions Must Act Now on Digital Assets, by Frank Mazza.
Right, that's the one. And his argument, it's pretty striking, actually. He's essentially saying fintechs are quietly pulling billions in member deposits away from credit unions.
Just by offering easy access to digital assets. And he thinks it's, speeding up, not slowing down.
So that's our mission today, really digging into that. We want to look at the evidence he uses for this silent drain idea, understand why he feels it's so urgent, and explore the solution he's proposing.
Exactly. What is the silent drain, and why does this author believe credit unions really need to act now?
Okay, so let's start with this core idea. Deposits are leaving. The premise here is credit unions are losing significant amounts, billions, but it's not just members chasing better interest rates.
That's the key shift the article points out. I mean, rates always play a role, obviously, but the source argues that a big and rapidly growing reason for money moving out now is just member demand for access to digital assets like crypto.
So how are these fintechs pulling this off? Are they competing on, traditional terms? Better yields?
Well, this is where it gets interesting. According to the source, many of these fintech platforms, they don't even have traditional deposit accounts like a credit union. They're pulling in funds simply because they offer fast, easy ways to buy and sell digital assets.
Oh.
They're winning on meeting that member expectation for, modern pools, not really on deposit rates.
So it's less about earning interest on cash sitting there and more about using that cash to get into a different kind of asset class.
Precisely. And the direct result, which the source really hammers home, is that every time a member moves money from their credit union to one of these platforms, while those deposits physically leave the credit union system, they're out.
Okay, so how does the author back this up? Is there data?
Yeah, this is where he brings in some numbers to sort of illustrate this drain. He points specifically to Robinhood, looking at their crypto revenue.
Robinhood's crypto revenue. Okay, what does that show?
Well, the figures presented in the article are pretty revealing about the scale here. Robinhood's crypto revenue went from just $27 million back in 2020 to an estimated $820 million by 2025.
Wow, hold on. From $27 million to over $800 million in 5 years. That's huge growth related to digital assets, just on one platform.
It really is an explosion. And the source makes another point. By 2025, this crypto revenue is projected to be nearly a quarter, maybe 24.1% of Robinhood's total revenue.
Almost a quarter of their income.
Yeah. And crucially, as the article stresses, Robinhood isn't operating with traditional deposits funding this in the way a credit union normally would.
So, okay. If platforms like Robinhood are making hundreds of millions from crypto trades, but they don't have typical bank deposits, where's the initial cash coming from? The money people use to open those accounts and buy the crypto in the first place.
That's the absolute core of this silent drain argument. Frank Mazza suggests a huge chunk of that startup money comes from members transferring funds out of their traditional accounts.
Accounts at places like credit unions.
Exactly. Transferring it out specifically to fund their activity on Robinhood or Coinbase or PayPal or similar platforms. It's that outflow from the traditional system that's directly feeding these massive fintech revenue numbers.
Okay, so the money leaves the credit union, goes to fintech platforms. What's the actual damage to the credit union when that happens?
Well, according to the source, it hits them in several ways, all negative. When funds go to these digital asset platforms, they often don't come back quickly, sometimes not at all. And crucially, unlike regular deposits, that money isn't earning interest or generating any revenue for the credit union anymore.
And I assume it's not available for the credit union's main job, like funding loans for other members.
Exactly right. Those funds are gone from the balance sheet. They can't support lending or other services. The article argues pretty strongly that, while trust and community focus are still vital for credit unions, they're just not enough on their own anymore to keep these deposits when members clearly want access to these newer digital tools.
That feels like a pretty blunt assessment. He's saying loyalty and traditional services just aren't cutting it alone in this environment.
It definitely raises a big question about, well, long-term relevance. The source argues the longer credit unions put off dealing with this demand for digital asset access, the more ground they lose. Not just deposits today, but maybe relevance, especially with younger members who see digital assets as just normal.
Okay, so if that's the problem, deposits leaking out to digital platforms, old strategy is not enough. What does Mazza suggest credit unions actually do about it?
The solution he puts forward is about strategic integration. He suggests credit unions should look at offering digital asset access themselves directly inside their existing mobile and online banking systems.
So integrate it, not necessarily like become a full-blown crypto exchange overnight.
No, not according to the source, anyway. It's framed more as a strategic move to meet members where they are, give them what they want, but do it using secure compliance systems.
Oh, yeah.
The goal isn't necessarily complex trading, but providing that access under the credit union's own umbrella within their regulatory framework so members don't have to go somewhere else.
Right, keeping them in the fold. And what are the upsides of doing this, according to the article? What are the benefits?
The source lists several key positives. First, integrating these services could directly help slow down that deposit leakage we talked about. Keep the funds inside the credit union. Second, it lets them offer crypto access while maintaining full regulatory oversight, which is obviously huge for them.
Keeping the relationship and staying compliant. Yeah, that seems essential.
Absolutely. It's also pitched as a way to build stronger digital relationships, especially with those younger mobile-first members who might already be using or curious about digital assets. And finally, the author sees it as just necessary future-proofing, getting ready for how finance is continuing to evolve.
Which brings us back to that sense of urgency in the article. The title itself says, "Must act now." Why such a push?
Well, the author wraps up by really doubling down. This deposit drain isn't just a theory. He presents it as real, measurable, speeding up, and potentially becoming irreversible.
Because once members set up shop elsewhere, getting them and their money back is tough.
Exactly. And the success of platforms like Robinhood, with those numbers we discussed, it just shows how powerful offering digital asset access can be for attracting and keeping user funds. The article's view is basically that members are already voting with their dollars. They're moving money to the platforms that do offer the digital tools they want.
So the author's final thought is pretty direct then.
It really is. He frames it less as a question of if credit unions should offer digital assets, and more like, how much more are they willing to lose in deposits, in relevance, before they finally decide they have to jump in?
So wrapping up this deep dive then, the core message from Frank Mazza's article seems clear. This demand for digital assets is a real and growing reason why members are moving deposits out of credit unions.
Yeah, and integrating these services directly is presented as, well, not just an option, but maybe a necessary strategy to stop that silent drain and stay relevant.
It definitely makes you stop and think, doesn't it, about how fast consumer habits around money are changing and what that really means for traditional players like credit unions.
Absolutely. And just thinking about the data presented in this article alone, like Robinhood possibly making over $800 million a year just by facilitating digital access by 2025. It leaves you with a kind of provocative question, maybe? If access to digital assets is already driving that kind of revenue for fintechs, how might that fundamentally change the entire competitive landscape for all financial services in the coming years?